Welcome. Today, we're covering a topic that comes up constantly in the self-directed IRA world. Real estate. People are familiar with real estate. Specifically, we're going to walk today through 7 distinct real estate options that can be held inside of a self-directed IRA. What each one is, how it works inside of an IRA structure, and what the compliance rules look like. Now, are there more than 7 options when it comes to real estate investing in an IRA? Absolutely. But today we're concentrating on some of the more common ones. So this is a real high-level view. Before we dive in, a quick and important note. Mountain West IRA is an administrator. We handle the administrative functions of self-directed IRAs. We do not provide financial, legal, or tax advice. Nothing in this video should be taken as advice of any kind. It's purely educational and designed to let you in on some of the exciting opportunities that are available when you self-direct your retirement account. Remember, always work with your own qualified advisors whenever needed. With that said, let's get into it. What is a self-directed IRA? Quick reminder of just the basics. A self-directed IRA is an IRS-recognized retirement account. It operates under the same fundamental rules as any other IRA. Contribution limits, tax treatment, distribution rules, but it allows account holders like you to hold a much broader range of asset options. The account holder, that's you, directs all decisions. The custodian or administrator, like Mountain West IRA, handles the administrative side. Simple, right? The key word here is self-directed. You are in the driver's seat. Okay, let's start with the most familiar option. Residential rental properties, single-family homes, duplexes, triplexes, small apartment buildings. All of these can be held inside of a self-directed IRA. Your IRA purchases the property, your IRA owns it, your IRA collects the rent, and your IRA pays the expenses. The IRA is the owner, not you personally. That's a critical concept to absorb. The IRA is the owner. Everything flows through the account. What does that mean in practice? If a pipe bursts, the repair comes out of IRA funds. If a property management company is hired, they get paid from IRA funds. The rental income, every dollar goes back into the IRA. And you absolutely cannot live in the property. Neither can your spouse, your kids, your parents. The property exists for the benefit of the IRA only. Residential rental properties are popular in self-directed IRAs because so many people have direct experience with real estate markets. If you know your local market, you know the kinds of decisions that are involved. Okay, let's talk about another option, commercial real estate. Office buildings, retail strip centers, warehouses, industrial facilities, all of these and more are eligible assets for self-directed IRAs. The same core rules apply. The IRA owns the property, income flows to the IRA, expenses are paid from the IRA. Commercial real estate often features longer lease terms than residential properties, 5, 10, sometimes even longer. Cash flow dynamics and management considerations differ from residential. Your IRA can own commercial real estate outright or even as part of a partnership structure, as long as the partnership itself isn't engaged in prohibited transactions. Okay, residential, commercial, raw land. This option is often overlooked. Raw, undeveloped land. Your self-directed IRA can purchase land and simply hold it as an asset. In most cases, raw land doesn't produce rental income, but it can be held within the retirement account structure. The appeal for most account holders holding raw land is simplicity. No tenants, no repairs, no active management. The IRA owns the land, pays any associated property taxes and any expenses if there are any, and holds it. You can lease the land to farmers. Just be sure to educate yourself on the requirements of water, insurance, and other items that you may not be familiar with if you've never been in that sort of arena before. Your IRA can also hold land that's being prepared for development. But remember, if you're developing it, if your IRA is developing it, all development related expenses must come from IRA funds. Okay, how about real estate notes? This is one of the ones that's probably the most versatile and probably the least understood, and that is real estate options in the self-directed IRA world. Real estate notes, also called mortgage notes. Here, your IRA acts as the lender. You're the bank. Someone needs financing for real estate purchase or a project. Your IRA provides the funds. They sign a promissory note. They make payments, principal, and interest back to your IRA, and the note is secured by real property. This is lending, not property ownership, but it's real estate-backed lending, which puts it squarely into the real estate category. And of course, if they default on the loan and it's secured with the real estate, you may end up owning that property inside of your IRA. Notes can be first position, primary lien, or second position. They can be performing, where the borrower is current on payments, or non-performing, where the borrower is behind. They can be originated directly or purchased on secondary markets. Now, the flexibility here is significant, but so is the due diligence required. The account holder is responsible for evaluating the borrower, the property, the loan terms, or any possible associated risks. Mountain West IRA does not evaluate notes or borrowers, so you need to be sure to do your due diligence. Always, always. Let's talk about another option. Private REITs, REIT. That's a real estate investment trust that is not publicly traded. We're talking private REITs. A private REIT is a pooled real estate structure. Multiple participants put capital in. The REIT uses that capital to acquire and manage real estate assets. Participants hold shares in the REIT. Your self-directed IRA can hold shares in private REITs. This gives your IRA exposure to a diversified real estate portfolio managed by the REIT's operators without your IRA having to purchase properties directly. It's much more of a passive investment. These private REITs are considered private placements. They're not listed on public exchanges and are not subject to the same disclosure requirements as publicly traded securities. Again, as always, due diligence is entirely the account holder's responsibility. That's you. Mountain West IRA does not evaluate, endorse, or recommend any specific private REIT or placement. Let's talk about one that's kind of unique, and that would be tax lien certificates. Okay, for those of you who've never looked into this, here's how they work. When a property owner fails to pay their property taxes, the local government can issue a tax certificate lien. Investors, including self-directed IRAs, can purchase these certificates. The certificate earns a statutory rate established by the jurisdiction. The property owner has a redemption period to pay off this lien. If the owner redeems the lien, your IRA collects the certificate amount plus the statutory rate. If the owner doesn't redeem, the process can potentially lead to foreclosure proceedings, depending on state law. Rules, rates, and procedures vary significantly by state and county. This is an option that does require substantial research and, ideally, experience in the jurisdiction that you're looking at. Okay, our seventh and final option for today is Tenants-in-Common arrangements, often referred to as TIC. In a Tenants-in-Common structure, multiple parties each hold an undivided fractional ownership interest in the same property. Your self-directed IRA can be one of those owners alongside other investors. Each party owns a specific percentage of the property, but everybody shares rights to the entire asset rather than owning a specific unit or portion of the property. Now, why does this matter? Because it allows your IRA to participate in larger investment opportunities that might otherwise be out of reach. For example, if a commercial property requires a $2 million purchase and your IRA has $500,000 available, a TIC arrangement could allow your IRA to own a 25% interest in that property, while other investors hold the remaining shares. In this structure, income and expenses are typically allocated proportionally based on each owner's percentage of ownership. If the property generates rental income, your IRA receives its share based on its ownership interest. The same concept applies to expenses like maintenance, taxes, insurance, things like that. Because multiple parties are involved, clear legal documentation is extremely important. TIC arrangements typically include agreements that outline ownership percentages, how decisions will be made, how expenses will be handled, and what happens if one party wants to sell their interest. For self-directed IRA investors, this type of structure can open the door to collaborative real estate investing while still keeping the investment inside the retirement account. As with any retirement account investment, it's important to review the structure carefully and work with qualified professionals to ensure the arrangement follows IRS rules and is structured properly. So, regardless of which real estate options you choose to explore, these or any other 5 core rules apply to all real estate investments in self-directed IRAs. The biggie, and we've already touched on it once today, no personal use. The property cannot be used by you, your spouse, your parents, your children, or other disqualified persons. 2, all income goes to the IRA. Every dollar of income generated by the asset must go directly to the IRA. All expenses come from the IRA. Every cost associated with the asset must be paid from IRA funds. 4, no self-dealing. Transactions between your IRA and disqualified persons are prohibited. If you need additional information on prohibited transactions, I've placed a link in the descriptions that will lead you to our educational resources on prohibited transactions. There's also UBTI awareness. If your IRA uses debt financing, a portion of the income may be subject to unrelated business taxable income. Consult your tax advisor, and if you need additional information on non-recourse loans in self-directed IRAs, I have also placed a link in the description that will lead you to some of our educational resources on non-recourse loans and debt leverage on investments in your IRA. So, 7 real estate options, 1 account structure, and the control in the hands of the account holder. Yup, that's you. Before we wrap up, remember that a self-directed IRA is simply an administrative and tax structure. The investments inside the account and the decisions surrounding them are made by you with the guidance of your advisors. The goal is education and understanding how the structure works so that you can make informed decisions about your retirement strategy. At Mountain West IRA, our role is to handle the administrative side of the account so your retirement investments can function within the proper IRS framework. If you'd like to know more about self-directed IRAs or even open an account, visit www.mountainwestira.com or give us a call at 866-377-3311. And of course, you can also use the QR code on the screen to connect with our team. And if you have questions about anything we discussed today or ideas for future topics you'd like us to cover, feel free to leave them in the comments below. Many of our future videos come directly from questions viewers ask. If you found this video helpful, please like it and share it with someone who might benefit from learning about self-directed IRAs. And be sure to subscribe to the Mountain West IRA channel so you always know when we release new educational content each week. Thanks for watching, and as always, keep learning about what is possible inside your retirement account. Until next time, bye.